Hi guys, welcome to another lecture. Really good to have you guys here again, and today we're going to explore a lot and something different. If you've been following the rest of the lectures, then I hope it's been proving quite useful to you. If you haven't been following the rest of the lectures and this is your first time here, welcome aboard to the channel, but remember to go back to lesson 1 of this lecture, because what it will do for you is provide you a learning opportunity. I always say that, really important, don't start from the middle. Market profile is a very in-depth subject. It requires understanding from the get-go. So if you want to be up to speed with what we're going to discuss, and you're not going to find this video incredibly boring, then I would suggest you start from lesson 1. I've attached a playlist to a card on this video, and I've also put it in the link in the description below. Plus you have access to my Discord server, where I've placed every lesson from lesson 1 in order on the main chat section. So do check it out. The link is flashing the bottom left hand side of your screen. You can always see it, so there's no excuse for you to miss it. I look forward to seeing you in the Discord. If you've got questions, you can DM me. I've been at this for a very long time. I've been a trader for a little over, give or take, 16, 17 years now. I think I know what I'm doing. I trade for a living. I don't really, I don't have anything else I do. This is what I do. Right, so again, I like to think that the wisdom that I'm imparting to you will hopefully change your life, because it has impacted my life in a very significant way. So I can definitely assure you that you will learn something by taking part in these lectures. And if you have anything else you want to ask, you can also DM me in the comments below, and I respond to all the comments that are about questions regarding the lectures. If you're trying to spam me, you're trying to do marketing, you're trying to do some other trick that, some other Gen Z trick, I will not fall for it. I'm not going to respond to those comments. Good news is I'm a millennial, so I've got no hard feelings about not responding to comments, right? And I block all those kind of comments. So please just ask comments that are relevant to the lecture, and I promise you I'll be able to help you. Right, but beyond that, let's get on with it. So what are we going to talk about today? Well, we're going to go over some of the things we covered in the previous lecture, which was we made a couple of calls and we had a few ideas, and we're going to see how those play out. Most importantly, I'm going to show you the trades that I've done, just so you know that what I'm teaching you here, I do myself, right? It's not something I'm just showing you. It's something that I do, and this is how I look at the market. So I'm going to show you what we discussed, the trade I took alongside that, because again, one of the people in Discord did ask me if I was in that position, and I said I was, and I had a plan regardless what happened. I'm going to show you everything that took place, so you have a very clear picture of what I was thinking at the time and how you should be thinking as a trader, regardless if you're going to be right or wrong on the trade. Good stuff. So we're going to start with cable, right? Because obviously, as you know, I'm a huge cable trader. That's kind of 90% of my trades do happen on cable, to be absolutely fair. Again, there's a small portion that I look at other assets that might require allocation, but 90% of my trades happen on cable. I also have a futures fund, so again, that's a separate thing to what I do. I also sell option premium, that's a separate thing as well. But if I think of my CFD trades, or trades that get made in FX or any other kind of CFD products, 90% of it is made in cable. So you will see me reference cable quite a lot, because it's what I've traded for a good part of 16 or 17 years. I'm not going to it. I know everything about it, so as a result, I'm going to default to it more. And of course, I'm a Brit, so I'm in a better position to understand the UK economy than maybe most people around the world. But all of that said, what I'm teaching you can be applied to every single asset, and you're going to see that because I continually demonstrate that through these lectures. Moving on. So I'm going to start initially. So we're going to go through process as always, right? So when you're working with the profile, you think about process. And to make it very simple, we go back to our trifecta, which is liquidity, volume, and time, right? Are those things aligning up? Can we see them? That will provide a trading opportunity. So I'm going to start with a longer frame, because we hadn't looked at that for a while. So one of the things that we've talked about before is where we are relative to the overall landscape. Right, so this is a weekly profile, so we can see that here. We had an initial push up last week, pretty major one, and then we started to enter into what would be that liquidity area. So we can see that by the higher day. So we always say that liquidity will be found at the high of day, low of day, high of week, low of week. If we're looking for liquidity within a time frame, say for example a weekly profile, we can always split that, and then we can see where the liquidity rests essentially every 4 hours. So high of 4 hour, low of 4 hours. So for example, we can see this consolidation block of pricing going downwards, and then we make a low and then rally. So there's going to be resting stop losses below these lows, for example, right? And these are all going to bring liquidity into the market. You should see this kind of consolidation as a bid or offer stack, if I condense it, right? So we can see there's offer stacks here, bid stacks here, bid stacks to the low, bid stacks to the low, highs, lows. So we can see we got that general picture. So we're searching initially for, is the market running to draw on liquidity? In this case, it is. It pushed up. So now we're above the highs of the weekly profile, right? So the highest high on this entire move, right, across weeks, this was the higher week, Y period. And it's also the highest price we've seen historically in cable up until this point. And then we've just blown across it. So if we're going to get short cable, what we would expect is that this market will eventually close back in, preferably below the bid stack, right, which is here. But again, if we can get below that, so now it is in, that's our expectation, right? And then we can start to visualize small rallies, larger drops, right? And eventually we should revisit bid stacks at these lows, right, which have been historical support, right? So bid stacks are actually really important, right? You can actually trade off these as a trading strategy if that's something you can explore. I will definitely advise you to go back and look historically on how bid stacks have performed, where the stop hunts have taken place, and so you can build yourself a picture. And then from that data, you can start putting on trades, right? It's always important to go back and back test data and forward test data. For me, I don't just back test, I forward look as well. And when you're forward looking, you should be taking screenshots and recording details on those screenshots, because what it will eventually do is give you forward data, because some of this data is going to get erased, right? So despite I have maybe a 40-50 look back on profiles, in 40-50 days, I won't have 40-50 days more in the past of look back. They will disappear. So if I've been forward recording as we go, then it means that I have those 40-50 recorded as screenshots, so I don't need to worry about going back. You know, there are a lot of companies in the landscape, everybody from TradeZella, you know, and all these companies. And by the way, in the description below, you can see that I have partnerships with some of these firms. So if you're interested in having journaling software and so on, just check the description and you'll see the details around that. But outside of that, there are firms who've built business models on being able to create forward data, where they've been collating data of trades, of screenshots, and they've put it in one platform, and it allows people to go back and see, essentially build a picture of what their actual trading is like, and where their weaknesses are and where their strengths are. I think this is pretty cool. I think it's incredibly important for traders, and the fact that software can do this now is just freaking amazing. Because if you go back 15 years ago, this didn't exist, right? So traders today have what professionals would have had, you know, 30 years ago. They have it all today. So it's just like taking a step back in time. You would have been like a Goldman Sachs or the trading world. And, you know, I don't think a lot of people take that into consideration, that the industry's moved on a lot, and there's a lot available now for you to kind of get into the game at a very high level, even though you might be a retail trader or a bit of a novice, right? We're all retail traders, to be fair, and that includes some larger institutions. Again, very few people are going to be considered what we call market makers, right? So reality of it is that there's a lot of tools today that are available to the everyday man and also available to people at sort of mid-institutional level. So there's literally no edge anymore in terms of, there's no information edge. There is some kind of a data edge, because data you still have to buy, and obviously the more money you have, the more cleaner and better data you can buy. There's definitely not a technological edge anymore. I mean, everyone's executing on milliseconds. You don't really need to be faster than that to make money. If you're faster than that, say you're on a nanosecond level, you're probably a high frequency trading kind of situation, right? So we all have massive internet speeds, so again, everyone can get access to 100 megabit connection now, whilst in the past this would have been only the top tier would have had megabit connection. Again, it's just the way it is. Right, so things have changed, and we have to bear that in mind. Okay, so we'll be visualizing the market dropping into these bid stacks levels, and from there we will be anticipating rallies again. Right, so this is the picture we should see develop if cable gets bearish. Now, if cable's going to get bullish, what we'll see, obviously in this week's print, is likely a reclaim of the J period high, and that opens us up for some more extension. Right, so reclaiming, we're going to extend, right, and that means we're going to be trading somewhat above the initial balance, right, which is also really interesting, because again, in the week the initial balance is 5, and if you look, it's very stable, especially with extensions. So if we extend one side of it, we're either going to fail on the extension, or we're going to hold it and then continue upwards, as was the case for last week and the week before. And then we had some consolidatory weeks, and we had a normal variation week where we got some kind of an extension, but eventually a rally off the bid stack. So the initial balance can be used as a way to gauge the volatility of your given asset class. So for example, I know that if I'm looking at an initial balance of, let's say, 88, then I know that we typically do double the initial balance, maybe double and a half, and on the odd occasion, maybe 3.5% of the time out of maybe 60 weeks, we're going to see a huge expansion where we're doing double, triple the balance, right? So if I know that double the IB is here, and this is double and a half, then we're looking at somewhat for the whole profile, 239. Pips, which is kind of average. What we expect for a weekly profile is to center somewhere between those 150 pips to, on the high side, 300 plus pips. So maybe 350 tends to be pretty steep. So for example, this one here was 400 pips, so it's a pretty big move. So usually when you see a weekly profile overextend like this, what we would describe as a trend week, we will expect that there's going to be some consolidation or even a pullback, right? So coming into the next week, we can assume that the market is going to fail to the upside at some point, right? Regardless of the time frame you're looking at, you're going to get a period where you're going to get big collapse in price action, right? So today's I'm recording this on the 1st of July. So again, if you go back to your charts on the 1st of July, you should see that obviously we have a bigger drop in cable coming into the US session. So the European to US session, it was a slightly bigger pullback. So you expect to see more pressure on the sell side when we're at these highs. And why does this happen? I'm a big person about why. It happens because we're trading where stops are. So at this point, rather than going up, right, what we're doing is we're hitting buy stops. So people who need to take profit can now liquidate onto those buy stops, right? Because those people who put buy stops are essentially telling the market that they're happy to pay those prices. And if they're happy to pay those prices, then there's always going to be someone willing to sell to them. So we're going to get an oversaturation of sell orders at those prices, mainly from larger entities. Why? Because in market profile speak, larger entities seek advantageous prices, right? Smaller entities seek fair prices. So for smaller entities prefer to trade around value. So essentially smaller entities consolidate the market. It's why we don't get enough range extension. So the market is not really seeking advantageous price. And in the case of large entities being present, the market will overextend seeking advantageous prices to either liquidate or buy something, which is why it's really important when we see these extending days. It gives us the idea that longer term money is now stepping in, and now we should start seeing very big reactions. So if we want to time when we enter the market, let's say we are position traders and we prefer to trade over months, and we're not trading, say, the intraday, then obviously understanding this will be crucial to you, because you're going to be looking for these one-off moves into big stacks on a weekly profile where, say, you might get long, right? So let's say we hit the bid stack, you might set a limit to get long, and then you might set a stop loss under value low, for example, of this week. Should be a good defense down there. Low likelihood of a stop hunt, because we've spoken about this before. The market really does fight hard to overcome values, especially value lows that are much further away. So if we've already extended value upwards and then price moves away, then it tends to revert back to value at some point. So it finds it really difficult to overcome its value lows, and we see that consistently. So for example, we start to shift value here. Notice the price opened here, developed value, but the market struggled to come down here and to come down to this level. So we see the same here, and we'll continue to see this, right? So value lows and value highs are going to present very decent resistance in the short to mid term. So if we're trying to take a long and we want to be in a position where we're confident that we're going to get our target level, then we need to put our stop losses where they're hard to reach. And that will technically be below value low of a prior weekly profile in this case, right? And then we can look now for targets to the upside, which might be a return to the weekly high, right? Where we expect there to be liquidity, which is what the market will likely seek. So if we are bullish and we're down here, you can expect that we're going to go up, seek liquidity before coming down again. So it's not going to be very rare that we're going to extend, especially after a few days of a drop or a few weeks of a drop, and not revisit the highs to draw out liquidity. Of course, we could fail at value high. So we could start here, trade value, and then reverse. If that did happen, then you could just protect yourself from that. So you can tighten your stop, for example, or roll it to break even if you're a bit worried. If I split this profile, you can clearly see that the E period extension was pretty much the decider. We had initiating buying within the value area, right? So we had this huge E period with essentially unopposed, there we go. So we got unopposed buying. So we bought within the value area. Prices were so competitive that we created a single print within the value area, and a single print will be essentially a price that was not traded before or after. So we have not revisited the lows of D period and the highs of D period, and we haven't revisited the lows of F period. So had G period come in, it would likely find significant support at this level based on a single print where it tells us that a strong, large party was initiating a move within this 4-hour window. Really important, guys. These are the nuances in market profile that cost you thousands of pounds if you wanted to learn this from an institution. Like most of the guys who trade with a profile would happily teach the profile, but not for less than maybe 15 grand. This is how it is today. If you want to learn proper trading, you're not getting it's not going to happen for free. I think I'm the only crazy person right now even giving you some of these basics on market profile for free. That said, if you want to get deeper and you want someone to mentor you through this is all too much, you can get in touch with me. That's why I've got a Discord server. Again, it's up to you, no pressure. I've worked with a lot of traders. I've helped a lot of people through this journey, and I like to think some of them are listening. I like to think some of them are grateful, and I'm always open. My door's always open because they can always contact me whenever they wanted to ask any more questions. If they want to sit down with me, spend half an hour, they can do that. So I like to think whoever works with me, they work with me for life. It makes sense. I think this is a long, arduous journey, and it doesn't make sense just paying money for something and then being spat out the other end without no one to kind of help help you or mentor you through that journey, because I think it's a mental game too. Sometimes you just lose confidence as a trader, and you need someone to boost that up. So it's not always just about show me that strategy, that technique. Sometimes it's not that. Maybe even what you're doing is quite good. Maybe you just needed some foundation, but the reality is that you just don't have someone questioning some of your ideas. So you're kind of in this vacuum, or you're dealing with other kind of toxic traders that probably don't know how to trade, and they're trying to question your ideas. You want to be in a professional headspace if you're going to do this, and that's what I like to say. Anyway, moving on. So if we look at what happened in a week, and that should put some perspective. So what we've seen. So if we got a high of week, that's the high of the previous week, and we traded above that high, and we closed to the downside in J period. Now, it doesn't take a genius at this stage to understand that we're going to have resting stops below the E period low, and that means that in relation to value, there's a high likelihood that we're at least going to trade the midpoint. So we may well end up dropping into the midpoint or bid stack, and then we might rally out from there if we're going to continue higher. Now, I have a thesis, of course, that cable's probably going to do the 140s, so I don't think this is the end of the move, and realistically we won't see the short side being activated until we're closing back into the trading range of this Y period high week, right? So unless we're back down within this range, then there's practically, in my opinion, very little hope for the downside to continue. So we need to first get back under this level. So this is still a very bullish setup. So if we're getting short, we have to take that risk into account, and it might be better to get short on a smaller time frame. So for example, rather than get into a position now for a pullback on a week, you might want to get in based on maybe a 4-hour entry, 50 pip move. Let's see if you can get maybe 2-to-1, or possibly somewhat 2.5, maybe even 3-to-1 before exiting, and then look at maybe protecting just about that 2-to-1. So that could be a way for you to maybe catch a potential move that we might be missing in that overall picture. But again, you can see we went up on I period with drawn stops on J. So really and truly, what we needed was pretty much a decent entry. It would have been really hard to make, because right now I like to enter on pullbacks, and right now I can't see one, right? We're just axing lower on K period, right? And the weekly profiles, 4-hour rotations, these are much bigger rotations. So again, you would see a lot of sideways movement within these auctions, right? And we're going to explore that. So again, we can see there was a stop run here. It's clear. My bet is that we start to deliver to the E period low. We'll have to see further analysis. So now that we understand a weekly picture and we get what's going on, let's pull back to the daily profile. So again, the daily profile is different from the weekly profile. It reflects profiles on the day. So there are a couple of interesting things that we can see immediately looking at the daily profile. So first and foremost, we can see that run on the stops at the high. So we can initially see that, and if we split the profiles, we can see we had a block of consolidation. So short-term money, the long-term money was there but exiting, right? So we're looking at what looks like a trend week, and then we consolidate, and then we do a test week, and then now we're pulling back. So that test is what essentially opened up the stops on this daily profile high and the weekly high. So you can clearly see as we pulled back in on O period, it gives you a tighter entry, right? So this was the O period low, right? I like to come in on the NASDAQ open. So that was 12 noon, so it was very, very pre-market, so pretty early. And then we had a bid stack below. So any breaking of that would open up the gap, in my opinion. So again, from where we are, we can see NASDAQ opened, it was pretty weak. And how do we know that the NASDAQ was pretty weak? Right, so if we pull this up here, right, we can use our tick volume bar and we can search for the time on the NASDAQ, which was here. So you can see the volume on the NASDAQ was extensively lower than the volume trading at 9 a.m. and the volume trading at 10 a.m. right? So you can see that here. Right, so the 9 a.m. volume, and this was the London volume, right? And we need to check to make sure we're looking at the 1 hour time frame, right? It doesn't affect the profile when we change the time frame, but it definitely affects the tick volume and all the other tools connected to MT4, with the exception of the profile. The profile works independently. So whatever you do, it's not gonna be altered by you changing the time frame. You've got to change that within its own settings. So we can see the NASDAQ was weak, but it was a little bit low for my liking. I tend not to want to get on the back of these moves, right? But let's say we've already seen the draw and we're going down, and with NASDAQ and we've got lower volume, right? So we can see that here, it's a slight peak, but definitely not higher than the 910 volume. Right, and that means that we're now trading Chicago, which is posting the highest volume, and we're still bidding. Right, so a good trade would have been to short the break of the NASDAQ low and make the assumption that this level, like most of the move was coming from the European session anyway. Right, so you can see that in L period. So that was that 11 o'clock volume that we're seeing here. Right, so if I just highlight that, that's what we've got here, and then we pulled back in O period to close here. So already there was probably a trade in O period, if you're a bit more adventurous, on the fact that there was a very high volume being closed against down here, right, coming into the pre-market. So there's a lot of pre-market selling basically. By the time we get to the NASDAQ, the market's pretty deep, and then the Chicago cracks the low, and we got very low volume. So it tells us there's no real buying interest in the NASDAQ, basically, to call a spade a spade. Now we have to see how Chicago behaves by the close. Right, now if Chicago were to come back, now if you notice, right, again, let's split these profiles, we're trading session lows. So we're expecting that we're going to find stops under session lows. And that's one of the reasons I say I don't like trading at what I call trading in the hole, where we're trading deep against a high. I like to trade from the high or not at all. So what I would be doing is I would be waiting for us to pull under and then recover before considering going long to take out the liquidity at a high. Primarily because I understand that volume from London tends not to be able to command the day, right? And I like to see volume come in from a US session, and that tends to be more commanding. So the M period high for me is what I call a poor high. So it has to be retested again. So it just gives me a picture that we're going to get much higher prices come obviously the future. And if we look historically, this was Chicago yesterday, right? So we go that, and that was Chicago yesterday. So you can see, and that's the trade we're going to talk about, right? So you can see the Chicago low yesterday, and then we traded in the NASDAQ and then rallied and broke above the NASDAQ high. I had a position for that, right? So this trade, and that my idea was to cover into the next day, because trading so late, I expect an extension through Asia and Europe, right? And that would normally take us to retest the high of the daily profile. So, right, so this would be a daily chart, for example, that would be the high of the daily chart. It's not difficult, guys, right? So just to obviously prove to you that this is something that I do, you can see that quite clearly here, right? Evident for you to see. Right, so this is my trade, right? So you can see that initially I was short, and I'll explain to you why that was the case. So if we split this profile here, right, let's split them all up. So here you can say this was the NASDAQ from the prior day. So if we just go back, you can take a look at the volume trading at that time. So that was New York, and that was NASDAQ, right? So again, New York, NASDAQ, right? So these two here. So you can say that we had a draw the previous day and stops at a T period high, closed lower, and then we started to pull back in. We can see that there's a heavy volume coming in the New York session, which is reflected here. And then we can see pretty much weak volume in the NASDAQ breaking the New York low. So for me, I wanted to be short round about here, and then I wanted to have my stops above the NASDAQ high, right? We shouldn't really revisit that. Now I was expecting a drop much further to close the gap, so I held on to this trade longer than I should have, right? And I didn't quite get my typical 2-to-1 that I'd look for, so I kept holding on to the trade with the anticipation that on this day we're going to break lower. But this didn't happen, right? And this is why I talk about improvising, because I'm well aware this was a session low, and it was also a low of prior day. The number of stops that are going to be down there will be furious for various reasons. So I wanted to be in a position where, so let me pull this lower. I wanted to be in a position where if we were to draw on stops here, I can act on that, right? So the moment we hit that level and we pulled back and we consolidated, I knew I needed to be long. And that's what led me to close the trades because I had significant size on these because I was in and I was in. So I had kind of doubled up on my position here for the crack lower, and then we hit this low and then rally. So in my mind, I immediately wanted to get out of this trade, which I did, right? So this for slight profit, this here for a slight loss, and then I'm the other way because I know what's coming, right? I didn't even need to waste time, and then I'm collecting at the top. So all in all, I'm net positive from these trades, right? So patience was the key. So you can see that here, that's the trade, right? So I was net positive on that. So I was able to get in here with stops just under the NASDAQ low, right? I'm not even concerned about getting it all the way under Chicago. I just want the NASDAQ low. And then I'm looking to liquidate as we come to run the stops here and here, right? So you can see I'm just before the high for my target. Not difficult, guys. And I'm using a combination of the second trifecta, which is volume, and I'm using it time, the third trifecta, which allows me my execution frame. And then I'm also using the other statistical benchmarks plus the first trifecta, which is liquidity, right? So I'm combining them. I'm not just coming in blindly. I'm using time as the entry point because I want to be where the best traders are trading. I don't want to be where the dumb money is. No offense. I want to be able to activate myself when the best traders are in the market, and that's NASDAQ, Chicago, to some extent London if you're trading a European session. Or again, if you're in Asia, you're trading an Asian session, it will be a different way to do things, which I won't talk about here. But ultimately, again, if you're trading that time frame, you're essentially trading with the biggest players. Again, you can see that, again, I'm using the same reference today, right? We're churning a lot of volume. Realistically, because it's Chicago, if we take out the Chicago low, then what would we expect? Very simple. We're going to go down and we're going to take out most likely the low here, and then we're going to draw on the liquidity, right? And that essentially would mean this very high volume here is broken, and that would lead to a long-term descent, which we can easily confirm on our weekly profile because things will be a little bit tight at that point, right? And then we can trade now, of course, any rallies to the upside will be essentially things we want to short. We're not there yet. And sorry guys, if I'm racing ahead on bringing all these concepts, don't worry, in future lectures we'll break them down individually at points. So the good thing about having these kind of sessions and these kind of lectures is it allows me to break everything down into tiny spots, go a little bit wild, come back. So it's a different kind of learning style, and I appreciate it's not everyone's cup of tea, but if you go over the videos over and over again, you would see from the lesson 1 to now, you would see how much things are being cemented in by doing it this way. So just be patient with the process, because you're not going to learn how to trade if someone is trying to put everything in a textbook for you. It ain't going to happen. Right, so hopefully that made sense. Let's delete some of these lines. and we'll keep watching this and see its behavior. And again, you don't have to be in a hurry to take this. I think another problem traders have is they're always wanting to be right at the moment they see a trade. It's like, all right, this is developing, I'm going to get long now, and I pray it works out, and then it doesn't, and then they complain. Look, wait for the confirmation. If you want to see Chicago close, we've got 9 minutes to the close. We're very deep. It looks like we're drawn on stops, but why would we want to just jump in off the back of this? We could, and make it a very low risk trade. Or we could wait and get a pullback in and a close above the R period high. That gives you a lot more of a commanding position. Or we could wait and see the S period low come in, right, and take out the R period low, and then we know this market's going much lower. In which case, if we're small time frame traders, this might be a continuation trade for you, right? Even though you're trading in the hole, which I don't recommend, but for some traders, the trade's set up and they want to go. Well, then go for it, but you just make sure your risk is reasonable above the R period high. You don't need to put your stop at P or Q, no point. Put it off the R period high. If that goes, you don't have a position anymore. Because what is going to rest above the R period high on this kind of volume, right? They're going to be effectively stops. And they're going to be buy stops that are going to be here where traders are getting short. When those buy stops get hit, I'm pretty sure that the buyers at these highs want to take this up. They don't want to just roll the stops and then break lower. So again, we just got to be conscious that if we've got in a position, we need to load our stops up there too. So if we're out, and we should be the other way, right? It's not really a thing for debate. And I think a lot of people want to debate these ideas, and they're just not debatable. This was a clear markdown into the session low, and we're building volume. So again, a crack of this session low would have a lot of writings on the wall. Again, if we don't, we crack the high instead, we're looking for the market to rally. Right, so you've seen the trade, you've seen the ideas, and you've seen how we put that into play. Hopefully that made a lot of sense to you guys in terms of building a picture of how we do that. And we'll check on this before, obviously, we close up this session, just so we see where things are. Now, if I pop over to another asset, let's take a look at gold. So it's no different when we're dealing with commodities, right? Again, gold is a CFD. I always say that US traders get ripped off because they're trading all these futures products that are very expensive. And yeah, their market making is good, but it's no different from a spot CFD. If you don't believe me, stare at a spot CFD with your futures feed and see if you see anything different. I normally don't. If I'm using a futures feed, it's because I can see maybe something like time and sales, right? So I can see what's been placed in the futures contracts. But typically, these markets are doing the same thing. There is no difference in what they do. They're all doing the same thing. So from where we are, we can see there's an offer stack here, which we've marked out on gold, and there was a bid stack down here, which we'd marked out prior, and then you can see we closed under that bid stack, and that's an immediate alarm bell that we're going lower. We should not be setting up like this, right? And that was confirmed when we broke the initial balance and we went lower. This is a daily profile of gold, right? So let's rehatch this. Usually at this point, I'll just take off the bid stack, no longer relevant. Right, so again, thinking about gold, we're working with our trifecta, same thing. Now, obviously this is a daily profile and this is a daily chart. If we draw liquidity below the lows, we're looking for a draw on that and then a rally. So you can see the market continue to draw under the P period low. Tons of trading opportunities here. So first and foremost, we form an offer stack, we break lower, confirming the offer stack that this was a downward day approaching. So trend day, consolidate, trend to test, right? And then we get a test day trading under the low. So we split that, right? This would have been a great trading opportunity. MT4 can be a bit fiddly with its tools. I can never really get a good grab on these things. Let's see. Okay, perfect. Right. So we can see traded below the low on A period, rallied. Give me a reason why you don't want to be long. There are a couple of things they've set up for you. You've got a value trade in your viewfinder. So we've come up, closed in on A period, traded a little bit low on B period. You should be in here, stops below the low. This is already a value trade. Once we're back into value, 70% probability, we go to value high, we dip back, we continue. So already you had 16-point risk. You're 45 points up on gold at this point. Where's the market likely to go? We know it's not done because we close. So if we condense this, this is where we close. So we've drawn on the stops on the daily chart, closed higher. So this entire day is now support, and it's going to lead to an extension. And what can we see? Bid stack below. So what's likely to happen? Position traders are going to step in because they're looking at a daily chart and they've seen a draw on stops, a close above. So we've seen the sell stops trigger, we've seen intraday sell stops trigger, and the whole day is closed higher. So we've gone from consolidation, balance, balance, imbalance, test, imbalance. That's the most likely path, right? Is that we're going to imbalance and keep going higher. So if we can see this close here, we know that the market's at least going to seek, split these, we're going to start to seek the T period high, or we're going to seek the K period high. And that's where we're going to get the next reaction, most likely. So that should be where we're aiming, because now this whole move has played into daily profiles. Close higher. Now, again, if we get another day of extension, we're going into the offer stack. So usually at this point, you can assess from this day what's happening. So we're closing low on Q period, and if we look at the time, that's Chicago here, very high volume. So again, it looks like we're setting up to sell off, and we should get good enough confirmation when we break the Q period low. If we rally and take the Q period high, then we're probably going to continue into that offer stack. If we take the Q period low, then we're going to probably continue down to maybe the low of session, right? Because again, we've already said that this daily recovery here is good enough support. So I'm not expecting the market to trade on the 3290. I need to see that happen, right? But I'm not expecting it to happen because I can see we've drawn the sell stops and we're now delivering prices much higher. So my expectation is we need to come into a really strong level if we're going to sell off. And for me, that will be this one here, right? And that, where is it? It's right in the offer stack. So for me, there's a little bit more interest there. But I always like to leave room for the analysis to be different from what I've just said. And if that happens, I don't care. I'm not about dogmatic. Did I get a call right? No, I just go the other way, because I've got a plan for either scenario occurring. So you can see that quite clearly. So again, if we trade lower, session low, it's going to be my interest. If we rally and we hold and consolidate and start to punch in new highs, then I'm looking for maybe a small bid to continue. This will be a continuation trade. If you don't like continuation trades, not a problem, then wait to see if we take out the low, and then you can miss this whole thing and then look for a reversal at a later stage. So you don't have to take a trade every time. You just want to be in a position to take one if an opportunity presents. So this is where we are, right? So again, if we can condense that, we can clearly see that if that does show up as a trade opportunity, that is one that we want to look at, essentially, right? So again, you can say it doesn't matter the market you're trading. Does it really matter if you were trading a futures? If you got this trade, for example, you'd still be 50 points up on gold and you'd still be making money with your broker. Why on earth would you care whether it's a futures product or not? Americans have to trade these products because they got a choice. If you're a European or you're a UK citizen, you got a choice, right? You can trade an American futures products or you can trade a CFD. In my opinion, there's more leverage on the CFD. There are a lot of good CFD brokers with offshore houses where you can get a ton of leverage. Why would you skip out on that, right? If you're a good trader, you know how to manage money, why would you skip out on that to go allocate more capital to a futures firm? makes no sense to me. It's the same complaint. Obviously, as time has gone on, I've said this to you guys before. I've really been averse to prop firms. I thought that the way they design themselves, set themselves up, is not great. Over time, I've seen a few firms tidy themselves up. They're trying to run a business model, and I can see it's working for the traders who are good. For the traders who are not so good and need more education, then obviously that's why channels like this exist and I exist. But if you know what you're doing, you should have no problem trading a prop firm. There are a few good ones out there, but again, we know that they're bad ones who don't like to pay out their traders. They like to do all kinds of crazy stuff. So go with the right firm, you tend to get the right results. And there are a lot of people making money out there with prop firms. And CFD prop firms, most importantly, you can make a lot of money from the CFDs. The futures prop firms, their rules are so crazy and they're so, it's just unbelievable that people think they're a preferable option to CFD firms. I just can't see the advantage in trading a futures firm. It's just none whatsoever. I'm not saying you can't make money trading with the futures prop firms, but the rules are so stringent when you compare them to CFDs that hands down you're better off trading CFD and making the money that way. That's just what I see. When I run the math of everything, that's what I see. I think futures firms are just completely there to clean out the traders, worse so than even the CFD prop firms. And I'm not just saying this. I've tried out some of this stuff myself, and I've got a very good picture now on how these things work and how these firms have been set up. And I've had a lot of conversations with people involved in these things, and I understand exactly what's going on. So if someone asked me, should you trade a prop firm? Absolutely. If you don't have the capital to come in heavy, if you do, no point. If you don't, then definitely do them. If you're a good trader, you want to allocate or you want to bring in more capital, then you could do it, and then it allows you just to expand your earning power, right? But if you're a bad trader, definitely get education first, right? Don't delude yourself that you're just going to start making money with prop firms if you don't have a game plan in order to do that. And you know, that one shot, one click trading where you're just trying to just wing it, it's not going to work either. Not with those kind of firms, not with the way they've set up their systems. You're just going to get caught out every time. Anyway, enough of the doom and gloom. It's all doable, that's my point. And you know, it's not a good idea to get into that negative space that CFD prop firms are now impossible and the way forward is futures firms. It is not true. The futures firms are way more savage and they'll take your money fast. You just have to be good when it comes to selecting CFD prop firms you want to work with. Look at their reputation, try and find out, are they really paying out their traders or not? And you really need to get into that headspace. So I reckon as a millennial, I'm a little bit more flexible with new ideas and new technologies coming in around trading and new business models. And some of the boomers or the older guys, Gen Xers, are just going to say it's all a scam and you should just open your own account. Well, good for them. I understand as a millennial, trying to raise capital was really difficult. A Gen Z, it's even going to be harder. So if you're a Gen Z and you're trading prop firms, or you're a millennial like my age, for example, trading prop firms, then go for it. I know how difficult it is. If you're a boomer, Gen Xer listening to this, you're probably thinking, maybe I should, maybe I shouldn't. Boomers are not going to touch this stuff. Those guys didn't, no offense, it felt like boomers didn't even really need to work for their money. Whereas if you think Gen Xers, well, you know, their parents were boomers, so they probably got it a little bit easier as well. So there's going to be that debate there as to whether prop firms are great, and most of the naysayers are going to be boomers and Gen Xers, and most of the people are going to be like, yay, they're going to be Gen Zs, and in the middle you're going to get millennials who are going to be like, this ain't that bad, it's a little bit better than when I started trading, which is the response you tend to get. But anyway guys, awesome stuff. I think we'll draw it to a close here. We'll talk about some more stuff in future lectures, of course, but again, thanks for tuning in. Till the next lecture, adios.